Government shutdowns have been treated as political theater, noisy but contained, disruptive yet temporary. Inside markets, though, they've always carried a quieter meaning, one that shows up not in headlines but in positioning, hedges, and liquidity behavior that rarely makes it into public discussion. When funding authority stalls, the machinery that validates data, clears trades, and signals confidence doesn't stop cleanly. It hesitates, and that hesitation is where metals traders start paying attention, because this time the background conditions look less forgiving. At first glance, a shutdown looks like a budgeting problem, not a market one, but beneath that surface, it interferes with information flow in subtle ways, delaying reports, distorting transparency, and widening the gap between what's known and what's assumed. Silver doesn't respond to speeches or votes. It reacts to uncertainty in the plumbing, and when traders can't trust the timing or completeness of official signals, behavior shifts quietly before prices do, raising a question most participants aren't asking yet. What's different now is the broader context in which this potential shutdown sits. Fiscal stress isn't isolated, and risk isn't neatly compartmentalized the way it was in earlier cycles. Available data suggests that positioning in metals has become more sensitive to policy disruptions precisely because other shock absorbers are already strained, and when one system stalls, pressure migrates faster than models expect, pointing toward consequences that aren't obvious on the surface. In dealing rooms, the conversation isn't about panic or politics, it's about timing mismatches and exposure windows. A shutdown compresses decision-making, forcing traders to act with partial visibility while liquidity providers grow more selective, and silver, sitting at the intersection of monetary hedging and de-industrial demand, absorbs that tension in a way few assets can. The market hasn't reacted yet in a way that draws attention, which is exactly why some desks are already adjusting. And beneath all of this is a more uncomfortable consideration. Shutdowns test confidence not through duration, but through precedent. Each episode trains markets to expect delays, exceptions, and improvisation, and silver has a long history of responding when confidence erodes incrementally rather than all at once. The early signals are subtle, but they're starting to line up, suggesting this story may be less about politics and more about what happens when trust pauses even briefly. The first place this tension shows up isn't in price charts, but in how traders manage risk around data dependency. Silver markets lean heavily on timely macro inputs, employment figures, manufacturing surveys, inflation readings, not because each data point moves price on its own, but because together they shape expectations about policy response. When a shutdown threatens to interrupt that flow, even temporarily, the market begins operating with delayed vision, and that alters behavior before it alters valuation. In previous cycles, data gaps were often absorbed without much friction because confidence in backfill and revisions remained high. Now, reports indicate that trust in retroactive clarity has weakened, especially when revisions arrive after positioning decisions are already locked in. For silver traders, this matters because the metal often reacts not to the data itself, but to the reassessment of narratives once new information breaks through the fog, creating timing risk that's difficult to hedge cleanly. This uncertainty changes how leverage is used. When visibility narrows, traders tend to shorten their time horizons, rolling exposure more frequently, or stepping back altogether. That reduces P-parent liquidity, even if volumes don't immediately collapse, and silver, already prone to sharp moves when participation thins, becomes more sensitive to marginal flows. The market can look calm while, in fact, the most dangerous periods are often the quiet ones, where constraints build without a clear release valve. Traders watching these developments aren't predicting outcomes. They're mapping risk, aware that once these pressures align, the market's response can be disproportionate to the initial trigger, leaving little time to adapt. There's also the question of perception, which matters more than many models admit. Markets don't just react to concrete disruptions, they respond to how participants believe others will behave under stress. A potential shutdown reopens a familiar debate about governance reliability, and even if the probability of prolonged disruption is low, the mere discussion can influence expectations in ways that ripple through asset allocation decisions, including silver. Institutional investors tend to reassess correlations during these periods. Assets that normally move independently can start behaving in sync when confidence wavers, and silver's relationship with currencies, rates, and equities becomes less stable. When correlations drift, hedges lose precision, prompting managers to rebalance portfolios not because silver's fundamentals changed, but because its role within the portfolio did. Those adjustments are often gradual, but they can accumulate into meaningful flow. Another subtle effect involves benchmark behavior. When official data releases are delayed or suspended, benchmarks tied to those releases can lag reality, creating tracking challenges for funds that rely on them. Silver-linked strategies, particularly those embedded in broader commodity baskets, may see mechanical reweighting or risk adjustments that aren't driven by price but by methodology. These mechanical shifts can move markets quietly without the narrative that usually accompanies them. Meanwhile, retail participation tends to respond differently. Past PATI, RNs indicate that uncertainty around government operations can revive interest in tangible assets as a concept, even if actual buying remains muted at first. Silver often sits at the edge of that psychology, accessible enough to attract attention, yet complex enough that behavior lags sentiment. The result is a widening gap between interest and execution, a gap that professionals watch closely for signs of transition. What ties these threads together is timing. None of these forces operate on a clean schedule, and they rarely peak simultaneously. A shutdown debate stretches attention over days or weeks, allowing positioning to evolve in stages rather than in one decisive move. That staggered adjustment is harder to detect, but it's also harder to reverse once it's underway, especially in a market as layered as silver. As these shifts unfold, the market starts to price not just what might happen, but how long uncertainty could linger. Duration risk becomes as important as direction, and silver traders who've navigated these environments before know that once duration enters the equation, outcomes become less predictable, setting the stage for the next phase of this story. One of the less discussed consequences of a shutdown threat is how it reframes policy expectations without a single policy action taking place. When lawmakers struggle to fund existing commitments, it subtly alters assumptions about future flexibility, especially around fiscal support and crisis response. Silver traders don't need new legislation to react to that shift. The implication alone can change how risk is priced across time horizons. This matters because silver often reflects second-order thinking. It's not the immediate decision that moves the market, but the inference drawn from it, what it suggests about institutional capacity and willingness to respond under stress. If a shutdown implies reduced agility, even temporarily, some traders begin assigning higher value to assets that sit outside direct policy control. That reassessment doesn't announce itself, but it shows up in allocati. In calmer periods, markets could absorb administrative slowdowns without much consequence because excess liquidity and confidence acted as buffers. Now, those buffers appear thinner. When a shutdown threatens to interrupt routine functions, it lands in an environment already conditioned to expect friction, making even minor disruptions feel amplified in their impact on silver positioning. Traders are also more aware of path dependency than they used to be. How the market behaves during uncertainty can matter more than the resolution itself. If silver trades erratically or liquidity proves unreliable during the shutdown window, those experiences get embedded into risk models and internal guidelines. The next time stress emerges, tolerance may be lower, and that feedback loop can change the market's long-term character in subtle ways. This sensitivity shows up in how counterparties are selected. During uncertain periods, relationships matter more than price. Some desks prefer fewer, more trusted counterparties, even if that means accepting slightly worse terms. That consolidation reduces overall participation and concentrates flow, increasing the chance that individual decisions move the market more than expected. Silver's structure makes it particularly vulnerable to this kind of concentration effect. At the same time, narrative risk starts to rival fundamental risk. Market participants don't just watch balance sheets and inventories, they watch headlines for cues about tone, cohesion, and control. Each missed deadline or shifting message adds another layer of ambiguity. Silver doesn't need a single alarming headline to react. It responds to the accumulation of doubt, and that accumulation can accelerate quietly. What's forming is a setup where reaction speed matters more than conviction. Traders want flexibility, the ability to pivot quickly if conditions change. That preference discourages large, static positions and favors optionality, a dynamic that can keep prices range-bound on the surface while increasing sensitivity underneath. It's an unstable balance that doesn't resolve on its own. As the window narrows, the market edges closer to a point where waiting becomes riskier than acting. When that threshold is crossed, Moves can happen without a clear external trigger, driven instead by internal constraints finally asserting themselves, and that's where the final implications of a shutdown threat begin to take shape. Behind closed doors, the final concern isn't whether silver should move, but whether the market can absorb movement when it comes. A shutdown threat tests resilience by stretching systems without breaking them, and silver sits in a position where resilience is harder to measure in advance. Traders know that when stress finally expresses itself, it often does so through execution gaps rather than clean price discovery. By this stage, positioning isn't about forecasts anymore, it's about readiness. Desks review exit scenarios not because they expect to use them, but because uncertainty shortens the distance between decision and consequence. In silver, where liquidity can appear adequate until it suddenly isn't, that preparation reflects an understanding that risk rarely announces itself politely. What's also clear is that resolution doesn't equal relief. Even if funding is restored and operations resume, the episode leaves behind information about behavior under strain, who pulled back, who provided liquidity, which structures held, and which didn't. That information reshapes future expectations, and silver, as a market sensitive to trust and optionality, carries those lessons forward more visibly than most. The shutdown debate then becomes less about politics and more about stress testing assumptions. Yes, or it does. Each day of uncertainty refines how traders think about fragility, duration, and confidence. Silver doesn't need a crisis to react, it needs a recalibration of beliefs, and those beliefs are being adjusted